Now, the Bank of England is expected to keep interest rates on hold at 5.25%. With expectations of cuts mounting, Governor Andrew Bailey will have a tricky balancing act in his communications around the decision. Well, Bloomberg's UK correspondent Lizzie Burden outside the Bank of England for us today. And Lizzie, you're joined by a guest.
I am Francine, and the outlook economically is very different to previous Bank of England meetings. So I thought we'd check in with Michael Saunders, former Monetary Policy Committee member, on how his outlook has changed for the Bank of England. Thanks for being back, Michael. Do you think that the Bank of England today should follow the Fed in pushing back against market bets for rate cuts?
I think what they'll do in their own subtle way is to signal that interest rates are likely to come down during the course of this year, but perhaps not quite as quickly as markets price in. And the way they'll do that, most likely, is forecast that if interest rates follow the market path, which includes quite sizable easing for this year, then inflation will end up a little bit above the 2% target 2 years out and 3 years out. So that implies the market path for rates is a little bit too aggressive, too low. But they'll also forecast that if interest rates are stable, then inflation will end up below target 2 and 3 years out. So the implication of that is that somewhere between stable rates and the market path for rates is what the Bank of England thinks we should expect.
Well, if the Bank of England basically thinks that markets are getting ahead of themselves pricing rate cuts, but then the forecast is based on the market path for rate cuts, is the forecast even worth the paper it's written on?
So the forecast aims to communicate if the bank thinks the market path is plausible or not. It's not really designed to be a forecast of where inflation will go if the bank sets interest rates in line with its own views. Now, it may well be that over the next year or two, the Bank of England will change the way in which it operates, do something more like the dot plot that the Fed does, in which individual MPC members give their own forecast for interest rates, and then they base the forecast, the MPC's economic forecast, on that. So then I think you would have a collective view on the outlook for inflation and monetary policy, which would perhaps be more coherent than they have at the moment.
They can also communicate the future path for rates through the guidance. Will it look tone deaf if they keep the hawkish bias in the guidance today?
Well, I think they will drop their previous references to it being a finely balanced decision of whether to hike rates or leave them on hold, and drop that little sentence at the end that suggests that they are still biased to hike. So their message will be on hold for now, but a forecast, as I said, based on stable interest rates, which implies that interest rates are likely to be coming down over the course of the year.
I'm interested when you would cut interest rates. Of course, we've got an election coming. If there's an early election this year, does that boost the case to cut sooner rather than later, so the bank doesn't look like it's helping Rishi Sunak's campaign?
So let's dismiss the idea that political factors would affect the path of monetary policy, except for perhaps one very narrow case. They might not want to make the first interest rate cut during an election campaign. I think their preference during an election campaign, the formal campaign of only 3 or 4 weeks, would be to just keep themselves in the background as much as possible.
So if that's in May, would you hold off hiking in May?
There might be a case for that. There might be a temptation just to leave it until the campaign is finished. But I have to say, I think June rather than May is probably the more likely time for the first cut anyway. The kind of sequence I would expect, leaving elections to one side, is to use the May monetary policy report forecast to signal the likelihood that interest rates are going to come down quite soon, give lots of speeches in the next few weeks, the few weeks after that, and then deliver the rate cut in June.
But if the bank doesn't cut soon, is there a risk that the bank's forgetting the lag in monetary transmission, both on the way out of this inflation crisis as well as on the way in?
Yes, there is, and that's part of the difficulty of setting policy. The lags in monetary policy are longer than they used to be. That implies, if anything, the monetary policy should act earlier, more aggressively, in order to offset those longer lags. But the risk of doing so is that pay growth services inflation are still relatively high, too high for comfort, and the risk of the MPC cutting early is they would send a message that they're happy with services inflation still being relatively high, and that might undermine their anti-inflation credibility. It's quite a tough balance between those two factors.
So if you were scoring the Bank of England's communications through this inflation crisis, where would you put them on a scale of 1 to 10?
Look, I think that all central banks will have learned from their experience through this. They've learned about how the economy functions and different ways of communicating. and you can see some advantages in the way that the MPC communicate. Equally, they would learn from the experience of other central banks. I think that's why this review by Bernanke is quite timely, quite useful. Let's take the chance to learn from the last few years, the last 10 years, 15 years, and see what works well elsewhere, and then perhaps adapt how the MPC communicates in the future on the benefit of that experience.
Well, of course, we also get forecasts today. If the bank does cut rates this year and that boosts growth, do you see inflation coming back in 2 or 3 years' time? Will that be an issue?
No, I think that the MPC have got on top of the existing inflation problem. Inflation is likely to be back at the 2% target quite soon, in the next few months, I think in April, and probably below 2% in the rest of the second quarter. Now, the challenge is then to make sure that inflation stays at target sustainably. And the thing to emphasize here is that policy is currently clearly restrictive, with interest rates well above neutral. If interest rates come down, let's say by 75 to 100 basis points this year, policy would still be fairly restrictive, helping to ensure that inflation stays low. And I think that kind of language of shifting from policy which is very restrictive to less restrictive but still on the tight side, that's the language shift which the MPC are likely to make in the next few months.
Just finally, Michael, economists keep forecasting inflation incorrectly. That's making markets more volatile, it's making the Bank of England's job harder, making policy. For you, how bad is the data situation?
I don't think there are any worries about the accuracy of the inflation data. I think the issue in the last few years is that the UK economy, and it's the same for other advanced economies, has been hit by a series of extraordinary shocks, from the pandemic, the energy price surge, big swings in global goods prices and commodity prices, and that's created an inflation challenge really unlike anything that we had in the 20 years before the pandemic. Now, I think this sense of a world in which adverse supply shocks are more frequent, that may be something that we have to get used to. And that means that inflation may well be more volatile than it was in a couple of decades before the pandemic, and that creates extra challenges for central bankers. It's important to ensure that inflation expectations are well anchored, and that would be a reason for the MPC to just drag their feet a little bit over the pace of easing during the course of this year.
OK, well, if the Governor or the ex-Fed Chair Ben Bernanke is listening with his review, there's some recommendations, a dot plot perhaps, when he reports in March. Back to you, Francine, and Michael Saunders, thank you for joining me.
Thank you, Lizzie. Thank you. Lizzie Burden there speaking to Michael Saunders, a former Bank of England policymaker. Now, stay with us for the BOE decision when it happens. And, of course, for viewers in the UK, we'll have a special coverage of the news conference led by Guy Johnson. And then a little bit later, also our conversation with the Bank of England Governor, Andrew Bailey. That's at 4 p.m. London time. Coming up, EU leaders head into a high-stakes summit on much-needed financial aid for Ukraine. Don't miss our exclusive interview with the Ukrainian finance minister. That's coming up shortly, and this is Bloomberg. Now, EU leaders kick off a high-stakes summit today on a €50 billion aid package for Ukraine. They'll have to persuade Hungary's Viktor Orban to drop his veto on the deal. Now, for more, let's head over to Bloomberg's Maria Tadeo in Brussels. Maria, it's going to be an interesting summit.
Yes, Francine, and you said this was a high-stakes summit, and it truly is. When you speak to European officials, they say this is the most important summit when it comes to Ukraine as compared to maybe 2 years when the sanctions were first introduced. They're very clear about this because of the repercussions. And to debrief precisely the ramifications of this, we're joined by Ukraine's finance minister, Sergei Marchenko, who joins us from Kyiv. Sir, today, of course, 50 billion for your country. You need that to pay for many things this year. What happens if you don't get the approval today?
Hello, Maria. Nice to meet you. Of course, all of us waiting for a decision, good news from Brussels. It's important for us that at least European Union is with us, because we're also waiting good news from the United States. It's necessary. It's not something we can compensate by our own budget. So we really need these funds from European Union, because it provides us midterm perspective as well.
And what happens if there isn't an agreement? The European Union says they could have a plan B, but do you have a plan B?
Of course, I would like not to think about plan B, because plan B it's to be in a different reality. We was in a plan B in 2022. I'm quite aware of what it means to be in a lack of resources when you should every day manage your liquidity gaps. That's why it can be very consequential for our economy, and I would like to do everything necessary to avoid Plan B and to convince our partners to step in and to help Ukraine.
Exactly, and you avoided a default in many ways, which some thought it was inevitable. But I wonder, having said that, the Ukrainian Prime Minister, Viktor Orban, he says he wants the capacity to review the spending on an annual basis and possibly veto this. Why do you think he's so concerned about this?
You know, our key concern is because of we really understand the necessity of such a support, and that's why we try to do all necessary efforts to communicate in a proper way, to show why it's so important for Ukraine and why it's so consequential for Ukraine. And it's not just a matter of words. I want to emphasize this. In January, we received a very minor amount only from Japan, $0.4 billion, and we plan and use only our own money, which we raise by taxes and by domestic borrowings.
And sir, the Polish Prime Minister, Mr. Tusk, he said that if there's no deal, Orban will be responsible for throwing Ukraine in a very, quote, dark scenario. What does a dark scenario mean to you? Because what he's implying is that with no money, you could lose the war. That's basically what it is.
Of course, you know, I don't want to discuss possible consequences on a battlefield, because I'm not responsible for battlefield, but I want to discuss a possibility for our macroeconomic stability. And the consequences can be very damaging. We can meet a huge level of inflation. We can fully exhaust our reserve of National Bank of Ukraine, and it will be economic crisis as a consequence of not having support from our partners. Of course, we try to mitigate the effects somehow, but we can't survive without support.
And at the start of the interview, sir, and correct me if I'm wrong, but I believe you said you're now expecting good news from the U.S. too. I know that the Treasury Secretary was in conversations with Kyiv recently. Do you believe the U.S., have they given you any indication that they will also pay up soon?
Yes, all of our communications which we had with our partners from the United States, they stressed that they are with us. They try to do their best to convince members of Congress and Senate to vote for Ukraine, to vote support for Ukraine. So we have no doubts that administration does every necessary steps to help us to get necessary support.
But did they give you a timeline? Did they say, we think maybe in the next 2 weeks is possible?
No, there is no clear vision on timing, so they're not committed on time, but they ask us to be aware that the money will come.
And sir, I have to ask you a question about the general sense of the Ukrainian government. As you know, there's many reports, and I know you're not aware of this file per se, but there's a lot of reports that President Zelensky may fire his top general. There's a lot of speculation out there. Perhaps there's tensions within the core of the Ukrainian government. The key has been unity, not just externally, but in your country too. How united are you with all of the pressures that you're facing?
You know, I prefer not to comment matters which are not of my responsibility. So please look at official comments from Office of President and President himself, I believe that we can find a good resolution of any possible conflict or crisis.
But the cabinet, in terms of you and your relationships, you're working as normal. You're working as you were working before.
Yeah, no problems. We all in a good relationship with Ministry of Defense, and we had a lot of meetings together, so everything's quite stable.
And sir, just as a final question, if there is a deal today, Ukraine was very specific that it needed the 50 billion euro green light in January, that it could not wait because it needed this visibility at the start of the year. So if there's a deal today, what's that going to do to your public finances? What's your budget situation looking like? And what do you see your shortfall being for 2024 if you get the 50 billion euros?
If you get 50 billion euros, it means that we at least partly finance until the end of the year. It means that we can guarantee support, and we can guarantee that we'll have been able to provide necessary expenses for our citizens. And we will expect this money rather sooner than later. In March, we received signals that if today is a decision, the first tranches will be in March.
And just as a final question, the last time we spoke, you said to me that to you it was clear that Ukraine has to win this war. There's no other option. Has anything changed in your view, or do you still believe victory will come, maybe longer time, but there's no other option for your country?
There is no option, for our country except to gain a victory. And it's a question of survival. It's a question of existence. It's not something we can debate, discuss, and make different trade-offs about. So it means that we should fight. It means that we should find necessary strengths within our country. It means that we should find necessary arguments for our partners to be with us. It means everything, because for us, it's not just the day-to-day business. We really believe that its existence of our country depends on our current deeds.
Well, sir, thank you very much for your time. And of course, on this very important day for Ukraine, that is the Ukrainian Finance Minister, Sergei Marchenko, joining us from Kyiv. And in the meantime, Francine, this summit continues. The question is whether or not there's a deal around Viktor Orban, who, funnily enough, today did not speak to the media, a low profile. That's very unusual from the Hungarian Prime Minister, who loves the camera and the attention.
It certainly is. Great interview. Our Maria today, they're, of course, following that special summit on Ukraine very, very closely. Now, coming up, we look ahead to the BOE rate decision, 12 p.m. London time. That's next, and this is Bloomberg. So Shell trading higher after the oil major beat expectations and kept up the pace of its share buybacks. Now, analysts were especially positive on the performance of its gas and upstream operations. Bloomberg spoke to Shell executive Wael Sawan.
It's a good, very good result for this quarter. We're pleased with the momentum that we are building after our Capital Markets Day announcement of June of last year. On multiple measures, whether it's on the cash flow front, where we see continued and consistent delivery, on the improvement in our cost structures and in the capital discipline, all that momentum is building through. But we also recognize there's more to do, and there's still a lot more to deliver in 2024. But we have high confidence in the strategy and in the pace that we are building to deliver it.
That was the Shell Chief Executive, Wael Sawan. Now, we're also looking ahead, of course, to the Bank of England's rate decision later today. Joining us now is Bloomberg's Ven Ram from the MLive team. Ven is the person I go to almost BOE decision, every BOE decision, trying to figure out what happens to gilt. So, Ven, I mean, it's going to be difficult, actually, for the governor and the MPC to guide the markets without giving them any forward guidance.
Morning, Francine. Absolutely. The markets are kind of riding their own hobby horse. They're thinking that there is a 70% chance of a rate cut in May. I don't think that's possible. I mean, one of two things has to happen for the Bank of England to deliver a rate cut in May. The economy has to fall off a cliff. Is that happening? Yes, the economy is weak, but it's not falling off a cliff. We got the January PMI numbers, which showed a reading of almost 54. That doesn't suggest an economy keeling over imminently. And if you look at the inflation picture, you've got headline inflation running at 4%, and you've got services inflation running at 6+%. So I don't know what it is that the markets are smoking. The Bank of England is in no position whatsoever to say they will cut rates in May.
And so, so is there a bias actually in the markets that is pushing, what happens to gilts on the back of this if they really push back, especially what we heard from the Fed yesterday?
Yes, I think that, Andrew Bailey will push back on that notion during the press conference. And the statement, indeed, I expected to reiterate that rates need to stay restrictive for longer, even though the best case for the Bank of England is that they may not have to raise rates from here. And I think the language might acknowledge that. But that is as much as a concession that they will get. I think the BOE has reiterated that message. Andrew Bailey said that in testimony to Parliament that unless services inflation comes down a whole lot, we are not going to see headline inflation crumble. Catherine Mann has made that same point as well. But it's, as you mentioned, it's a point lost on the markets, but they will realize in good time.
Thank you so much. As always, Venram, they're looking at some of the BOE conundrum and decision. Up next, it's a Bloomberg Brief with Manus Cranny in New York, and this is Bloomberg.